Hello, everyone. I'm Fyruz Khan, and today I'm back with a brand new class. If you haven't liked our Facebook page, please type in Fyruz Education Services and like our page. We have lots of educational content for you. You can also subscribe to our YouTube channel. We have over 80 videos absolutely free. It's convenient and easy to find. Everything is compiled on a playlist. So that's that. We will start shortly. We're just waiting for some students to join. So, yeah. Okay. So, in companies or organizations, you have income statements. It's very common. Every organization has it. And in income statement, you have a lot of information about product sales, about service sales, about operating income, expenses, interest, income tax, and a lot of sensitive information. So once you've created an income statement, after that, to change something is very difficult, right? If you want to change a figure, if you want to make amendments, but life is not always easy for us. Life is not always the same. We have to go up and down. We have to change. Let's say after you've made the income statement, you may have to insert a figure in your income statement. And what do you do? Of course, you can insert it, but you have to be very, very careful because you've already drawn up the document, and one small change will affect other factors, will affect other figures. Therefore, you have to be very, very careful. The first rule is use the same format, use the same accounting rule, use the same structure while changing. Do not do anything that is different. Do not do anything that is different from what you've done previously in that particular income statement. Okay, use it in just that way. And you have to be careful when you insert that figure. You have to see, okay, what other likely effects will it have in other factors or in other figures? Because if you change the number of units, the revenue, the sales, the tax, the loss or profit, everything will be different. Everything will change. So you have to keep that in mind. Overhead expenses may change. So look at everything. Okay. So before you put a figure, just do some kind of analysis, do some kind of rough work on the side before touching the main document. That, okay, this is the change that we have to make. What are the problems that we can face, or how can you do it without affecting the income statement? Look at the possible scenarios. Okay, so that's that. If you have any questions, do not hesitate to comment down on the comment section. I will take your question. Even if I'm late, I will answer it to you as soon as possible. Okay. Um, let's talk about Facebook. Now, Facebook is such a big company. They have a very good reputation. They have a very good brand image. And companies like Facebook, or companies like Apple, or companies like Levi's Jeans or Levi's Jeans, however you may call it, or a company like Tesla, they have a huge reputation, a very good brand image. We can also count Amazon, and for these companies, their reputation is bigger than their assets. What I'm trying to say is, let's say the total value of Facebook is $90 billion. This is not a real figure. This is fictitious. I made it up. So let's say the total value is $90 billion. Now, let's say I want to buy Facebook. Now, they will sell it in $150 billion. Now, you may ask me that, okay, why do we have to pay extra $60 billion? Extra $60 billion is because of their reputation. Extra $60 billion is because of their image, right? And because, over the last 10, 11 years, they have earned this reputation. New companies can't do that. They have survived over the last 10, 15, 20 years. They have a loyal customer base, and everybody knows this logo. Everybody is familiar with the company, and this is why they will charge extra $60 billion or $50 billion or even $100 billion because of their the image that they carry, brand image. And this is often known as goodwill. Okay, you've paid extra $60 billion because of the goodwill. You can of course start your own social media, but will you have Facebook's goodwill? That's the question. That's the key. So instead of making your own social media, what you do is you buy Facebook because it's already in the market. They have a huge customer base. They have billions of dollars in revenue. They have several other companies, and you. This is why you pay this extra $60 billion. And if I buy Facebook, it will appear on my statement of financial position, not yours. You're selling it. It will appear on my statement of financial position. But as soon as you buy this company, you have to write off the $60 billion. Why write it off? You can't have the $60 billion in your statement. You have to eliminate it. You have to eradicate it because goodwill is not permanent. Today, Facebook has a very strong goodwill, but tomorrow they may not have a strong goodwill. Somebody may do something, and the employee of Facebook, the CEO of Facebook, they may do something that may harm the brand image of the company. And it has happened in the past. We have seen many CEOs of big companies, they were entangled in legal matters, and their company stock went down. We often read this kind of reports, right? So we have to write it off as soon as possible. One more reason is it is an intangible asset. This this is a tangible asset. Okay, tangible means I can touch, I can hold, I can see, I can feel it. But goodwill, you cannot see it, you cannot touch it, you cannot hold it. So it's an intangible asset. So how can you have that in your financial statement? And the second reason that we've talked about is you have to write it off because goodwill can be damaged very quickly. Businesses can harm their reputation very quickly. Today, Facebook has a very good reputation, but tomorrow, when you wake up, there may be a news, and that's it. The stock prices will go down. So business reputation and image can disappear very quickly. And keep this in mind. This is quite important. New companies will never have goodwill, right? When you start a company fresh, when you're a startup, you don't have a loyal customer base. Suppliers are not aware of you. The market is not aware of you. You have to build that over the years, over 10, 15, 20, 30, 40 years. Sometimes it takes 40, 50 years to create that image and goodwill. Okay? So new companies will not have that. And there's this other problem. The other problem is, okay, I've paid Facebook $60 billion for their goodwill, but what was the deciding factor? How did we come to this value? How did we come to $60 billion? That's the question. Um, there was no point of reference. It's just an assumption. So there's no way you can calculate goodwill. That is a big problem. Someone can agree to pay $60 billion. Someone may even agree to pay, $10 billion. We don't know. So there is no point of reference. There's no way of calculating it. That's the biggest problem. Okay. Now, WhatsApp in 2014 was sold for $19 billion to Facebook. Facebook bought WhatsApp for $19 billion. You can Google and check the news. Okay. WhatsApp's revenue was only $10 million in 2013, only $10.2 million. They lost $138 million, okay, in that very year, in 2013. But why did Facebook pay $19 billion? Why? The question is, they paid so much of money, they paid a staggering amount of $19 billion because of growth. Okay? WhatsApp was growing rapidly. WhatsApp was growing, enormously. Okay? In 2014, 500 million people used WhatsApp. Okay, the growth was enormous, the growth was unstoppable, and this is why probably the team at Facebook, they could see the future, they could predict the future, that this is going to be something gigantic, and they wanted to have this company in their hand. And also, it is similar to Facebook Messenger, right? It belongs to a family, it belongs to a set. I spoke about family products in my last class. So that's that. 1 million users signed up every day. 1 million users, okay? And 70% of WhatsApp users were active daily. This is a big thing. This is a big advantage. And this figure is just madness. 500 million pictures were shared per day. 500 million pictures. Just think, I share 5 to 6 pictures every day on Facebook. So just think about, 2 billion users sharing 5 pictures every day. So think about that. So Facebook paid $19 billion because WhatsApp was growing rapidly. In spite of their, tiny, puny revenue, they were convinced that this company would become very big in some other day, in some of the, in the future. And, they could use them for their different products, for the different services. And Mark Zuckerberg was very clear that, in the future, he wanted to integrate WhatsApp and Instagram with Facebook. He gave an announcement when he bought these products, and that's what happened, right? And we can see that, because WhatsApp was also a very different product. You could call, you could send text messages just with the help of internet. You didn't need to have a cellular connection, so it was quite different, innovative. Okay, so yeah, reputation and prestige of a business can give value, like WhatsApp. They had a very different product. They had lots of users. They had a huge growth, and that's why Facebook agreed to buy WhatsApp. And it will appear on the buyer's statement of financial position. Okay, and of course, when you add goodwill, it will always be more than their asset. Okay, I've given you example of Facebook. You can have a look again. Okay, let's say total value is $90 billion. You're going to sell it for $150 billion. Okay, more than their asset when you add goodwill. And then and then we've already talked about this. Goodwill will not appear on company's account because of two reasons. Businesses can harm their reputation, can harm the brand image very quickly. They disappear very quickly. It's possible their image can be broken down in just one night, overnight. So that's why you have to write it off as soon as possible. Okay, so keep that in mind. Um, yes, and again, we have a book example here. Same, let's say business A buys business B for $2 million. The actual value of business B's asset is 1.5. Why did you pay 0.5 million extra? Because of the goodwill. Okay, so there we go. And goodwill means that the business has is well known, is well established. They have good trading links with consumers, with suppliers, with the business community. Okay, they will have a lot of advantages. But then it's all intangible. You cannot see, you cannot hold, you cannot touch. It's all imaginary. It's in the head. This is why you take it out, because you don't know where it is. It's intangible, and then it can disappear very quickly because if it harms businesses' reputation and brand image, right? Um, just give me a minute. If you have any questions, please do not hesitate. To write down your questions on the comment section. I will take it. I will answer to your question. Please use this opportunity to study. It's a free class, complete lecture, everything according to the syllabus, right? So there are two accounting conventions regarding goodwill, and we've spoken about it. We are discussing it again and again so that you can understand and you don't forget. Okay. Um, it should not appear as an asset in the existing business because it is difficult to value and it disappears rapidly. Okay. That's one convention. Second convention is, let's say if I buy Facebook, it will appear on my statement of financial position as a non-current intangible asset. Okay, because today the goodwill is worth $0.5 million, but tomorrow it may not be valued at $0.5 million. So these are the two conventions. It should not appear as an asset because it disappears very rapidly, very quickly. It's difficult to value. There is no formula. You can pay $1 million as a goodwill. I may pay $20 million. Some of the people may pay $100 million. We don't know. Okay. Different people will pay different amount. Like Google wanted to buy WhatsApp and they offered $10 billion. So according to them, the goodwill was around $10 billion, but for Facebook it was $20 billion, almost $20 billion. Of course, there were personal reasons attached to it, that he wanted to use WhatsApp services with Facebook and Instagram all integrated together. So it's different for different users. And it will appear in company's non-current intangible asset. Okay, because this $60 billion of goodwill or $0.5 million of goodwill may disappear very quickly. So goodwill is an intangible asset, and trademark can be a goodwill. Just look at the picture, trademark. I'm sure you've seen TM trademark. Okay, and patents, copyrights. We'll talk about this right now. So a trademark is a symbol, is a logo. It's a word that is legally registered, right? And Nike, Apple, these are all trademark. And when you buy a company which has a strong trademark value, then everybody will recognize your company. Think about McDonald's, think about Nike, think about Adidas. As soon as you see the logo, you know it. Okay, it's simple words that are legally registered and nobody can use them because it is legally registered. So this is a goodwill, right? It's not in the syllabus, but then I feel that you should know all these things. Then you have copyright. Copyright means that, let's say you make wallets, you make these wallets, okay? You make these wallets, and you will give me the right to copy this item, to make this item in my country. Let's say you are in Zimbabwe and you give me the rights to make this wallet in Bangladesh. Okay? So that is copyright. Legal right to produce or manufacture something for a period of time. Let's say for 5 years, you've given me the right to produce and manufacture this wallet, this beautiful wallet for 5 years. After 5 years, you may agree to renew the contract, or you may ask me that, okay, you don't want to continue with the agreement. And then we also have, if you look at the picture here, document, we have patents. Patent means you've come up with something new. For example, let's say when iPhone came out with this infinite scrolling, that was a new feature. Like you could scroll like this, infinite scrolling. Okay, you could scroll infinitely, and they have registered it as a patent because it was something new. And when you register as a patent, you have to go to the government, you have to register it as a patent, and when you do that, It will not allow anyone to make the product, to make similar product using or selling your invention. Okay? Nobody can copy your product because you have invented something new, you have patented it, and nobody has the license to do it for a certain period of time. Okay? It will exclude others from making, using, or selling your invention. So these are all what I would say is a goodwill. And big companies like Facebook or Nike or Adidas, Google, Amazon, Tesla will have these kind of goodwill, brand image, brand logo, and patents, copyrights. So there you go. And they add value to the company. They don't exist in a physical sense. They're not physically there. They're not tangible. Like this wallet is tangible, but they're not tangible. But they have a lot of value. Okay. The two main problems we have discussed about this: we don't know how to value them. Because let's say for this logo, you may agree to pay $1 million, and for me, it may be $5 million. There's no benchmark. There's no formula. There's no standard. Okay. Um, and you don't know whether they should be included in the company's statement of financial position or not. These are very technical areas of accounting because they disappear very quickly. Okay. So keep that in mind. And why do they disappear very quickly? It's because something can happen to the company. Let's say an event, a disastrous event, and it may harm the company's reputation or image. Okay, we have already talked about this. Okay, so however, we need to recognize that intangible assets are difficult to put a value on. Assets that are intangible, that we cannot see, it's very difficult to put a value on. It's very easy to put a value on this wallet. We will look at the leather, we will look at the price of the leather, weight of the leather, what kind of material you've used, and then we can, gauge a certain price. But for something that you can't see, how do you value on it? Okay. Um, Statements of financial position prepared under normally accepted. So you do not put your goodwill in, you do not record them in your statement of financial position unless it's a takeover, unless someone is buying it or merging it, okay, or going through a merger. So that's that. But having said that, trademark or copyright or patent, these are all based in, I mean, these are all considered as knowledge based economy, and we are moving to knowledge based economy. What I mean is that think about the companies that became big over the last 15, 20 years, like Google, like Amazon, Facebook, Instagram, okay, LinkedIn, and there are plenty. Now, what is the value? I mean, it's a website, right? The value is the data. The data. They have, data of billions and billions of users, right? Information about us, pictures and data, what we do every day, when do we get up in the morning, and what do we search on the internet? What do we buy? Our credit card information. What kind of pages do we go every day? So, these kind of companies are coming up nowadays. Okay, so they will not have any physical presence, but they're intangible and they will have a lot of value. So we are moving to knowledge-based economies. Okay, you'll have scientific research companies, publishing, music companies, social media, websites, all of those things. Okay. So, yeah, we've already talked about that. The market value of companies with considerable intangible assets will be much greater than the net asset value, and we have seen this in case of WhatsApp. Their revenue in 2013 was only $10 million, and they sold the company for $19 million. Okay, it was way greater than their asset. So, yeah, if you have any questions regarding Goodwill, please do not hesitate to comment on the comment section. I will take your question and answer it as soon as possible. Next up, what do we see in this picture? We see a car, we see a woman, refueling her car. So, what is car? A car is a capital expenditure, right? Capital, equipment. It is a machinery, machine, tangible asset that you could touch, hold. It has a value. And what is fuel? Fuel is, what does fuel do? It helps you to run the car, right? It helps you to run the car. So, it helps you to run your business. I mean, if you have a car. So it is a revenue expenditure. Both, I mean, for both, you need money, okay? For both, you need money, but then fuel is not an asset. It helps you to run your car, okay? It helps you in day to day activities. But then car is an asset, so it is considered as a capital expenditure, and fuel is a revenue expenditure, okay? It gives you a short term benefit. For example, if I refuel my car, if it's a full tank, I can drive for about 9 to 10 days. So it gives me a short benefit for a certain period of time. But car, when you buy a car, you can use it for at least 10, 15, 20 years. Long term benefit. Okay? And how, where do you record revenue expenses like fuel? Of course, you do it in your year's income statement, each year's income statement, and the profit will go down because it will deduct from your profit. It will minus your profit. Okay? So that is that. So this is capital and revenue expenditure. Today we've just talked about revenue expenditure. Capital expenditure requires more time, it's more complicated, it has more theories associated with it. So I will come again tomorrow to explain you more. So if you've liked what I've taught you, do not hesitate to press the subscribe button on our YouTube channel. You can also press the bell icon. So whenever I upload something new, you will get a notification, right? It's all free. You don't have to work hard. Just press. Okay. And thank you very much. I had a great time teaching you this concept. I've seen a lot of people are watching our videos on YouTube. Thank you very much, and please do forgive us if there are any mistakes. If I'm trying my best to take the quality. So thank you very much, and I will see you soon.